Corporate finance practice problem using OneNote. Offer of acquisition and impact on stock price. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, the Practice Problems tab down in the 2020 Offer of Acquisition and Impact on Stock Price tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will also be in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on the right and down below. We're looking at an acquisition type of situation, this time from the perspective of an investor, thinking about a situation where one company is acquiring or merging another company. What then would be the impact on the stock price? What would be the impact if you were going to speculate basically on a merger type of situation? So our scenario, we have A is thinking of purchasing B. We're thinking of these two separate companies, and the B stock is currently trading at $50. So the offer plan at a % premium over the market price, meaning the offer is going to be for 67% over the market price of B. So in other words, A offering 67% over the $50 B stock price for the offer, remembering that when we think about the value of the company on a market basis, we can basically take that $50 and multiply it times the number of shares that are out there. That's what the market is currently valuing these shares at. Now, of course, if one company was thinking about purchasing another, they're probably going to be offering a premium, given the fact that if they consolidate all those shares together, there's going to have some kind of cohesion with their company and whatnot, and therefore you would expect them to typically be buying at a premium. In that instance, then that new price would basically be what you would expect, in essence, the new market price to be, given the fact that this transaction here is basically a market transaction between these two companies. The one company is trying to value what the other company is worth and make an offer compared to or in alignment with what they think the company is worth. So assume the stock goes up to $60 to $71. So we're going to imagine a situation where the word got out that there's going to be a merger or possible merger that could be taking place, offer being made. That increases the stock price to 71, the market reacting positively to the merger, especially given the fact that the company that's being purchasing here has shares that are higher than the market price, assuming then that the value of the shares would be basically go up due to the merger. But the merger isn't for sure there, even if there was an offer that was made. So we're going to assume that we buy the stock at this price, at that $71, and then think about what would happen if the merger goes through or does not go through. So in other words, if the merger goes through, what is the gain that we would have, or the percent gain, or total gain? If the merger does not go through and the stock price falls back down, what is the percent loss? And there's going to be a 75% probability of the merger. So in other case, we bought the stock price here, hoping then that the merger goes through. If the merger does go through, then what is going to be our gain? What are we going to project our gain to be at that point? If, on the other hand, the merger does not go through, then we assume that the stock price will fall back down to that $50, and then we can think about what the loss would be in that instance, and then we can try to figure out our expected return by estimating the likelihood for the merger to go through and using our expected value type of calculations in order to figure the expected return, hopefully helping us make a good decision. So we're going to first take a look at the value offered per share. We got the $50 price before the offer takes place, and then we've got the offer at 67% over the stock price, giving us the value offered at the $83.50 per share. So in other words, we got the $50 times the 0.67. That would be the premium, plus the $50 would be the $83.50, or we take the 1 or 100% plus the 0.67, 67% for 1.67 or 167% times the 50. That also gets us to that $83.50. So then we can look at the percent gain, which would simply be the sales price. So we're going to assume then that that is going to be the new value, because that's basically the value that's being determined by this offer that's going to be taking place. So the value then, or the price would be that 83.50 that we'd be getting if the merger basically went through for the shares. So we got the 83.50. We've got the purchase price is going to be the 71, and the gain is the difference between the two. The 83.50 minus the 71 is the 12.50. If we compare that gain to the purchase price, we got a 17.61% gain. So once again, 83.5 minus the 71 that we bought it for, and that's going to be the 12.5 on the gain. So dividing that by the amount we purchased it for, the 71, would give us a 17.61% gain about. So then we can say, okay, well, what would happen if the merger doesn't go through and we don't get the 83.50 in essence from the merger going through, and we assume then that the stock price goes back down from the 71 to the 50, which is the reason it's at 71 is because it's the likelihood that the merger went up. The stock market responded positively. Why didn't it go up to 83.50, the value that A is thinking of offering B per share to buy out? Because it's not for sure that the offer is going to go through. So you got some risk that's going to be involved there. So now we're going to say, all right, well, what would happen if it didn't go through? We'd have the sales price of 50, and then the purchase price, assuming we sell it here, and the purchase price is going to be the 71. The difference between the two would be a loss of $21, and 21 compared to the price would be a 29.58 loss. So once again, 50 minus the 71, 21 divided by the 50 would give us, hold on a second, the 50 minus the 71, 21 divided by the 71 would give us a 0.2957 or 29.58 about loss. So now we've got a percentage gain and the percentage loss. The percentage loss is greater. So if there was a 50-50 likelihood, then you would say, well, then the percentage loss is greater. But it's not a 50-50 likelihood. We're thinking it's probably going to go through. We're thinking there's a 25 or 75% likelihood that it goes through. This, of course, is some kind of estimate. We're going to try to get it to our best guess so that we can then calculate what we would have the expected value to be. So if we think it's going to be 75% likelihood it goes through, we could do an expected value calculation taking the gain of the 17.61 times the 75% likelihood that it's going to go through. And that would give us, if we take the 0.1761 times the 0.75, that would give us the 13.2% about. And then we can take a look at the percent loss that we calculated, or if there was a loss, 0.2958 times the likelihood, which is if 75% is the probability the merger goes through, and there's only two things that can happen here. Either the merger goes through or it does not. 100% minus 75% would mean that there's a 25% likelihood that it does not happen, which means we would result in that loss. So we're going to say the 0.2958 times the 0.25, and that's going to give us the about 0.07395 or 7.39%. So that's going to be on the negative side. So if we subtract those out, we're going to say the 13.2 minus the 7.39 in percent format would give us the 5.81%. So given our expected value, we have a 5.81% on the expected return in the positive.